I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome back to another episode of Operators and Allocators. This is your host, Dylan Marma, and today we are joined by a guest who I'm very excited to learn from. I think we're all going to walk away from the show with some great gold nuggets. It's someone that has broke into the multifamily space over the last few years after serving a long career as a veteran of the New York City Fire Department, and is currently still the lieutenant for the Borough of Queens. As he was working and serving the city, he began to invest passively with the goal of being able to create freedom for himself and for his family. And sure enough, he caught the real estate bug and wanted to have a more active piece of the pie. And he saw this as being a vehicle that he could use to be able to help impact the lives of a lot of others. So then he went on to close on over nearly $150 million in real estate, over 900 units over the last few years. And today we're going to be joined by none other than Mr. Tim Lyons. Welcome to the show, Tim.
Dylan, thank you so much for having me on the show. It's a pleasure to be here.
Awesome. Well, definitely excited to have you here, Tim. And would love to just start off with, tell us a little bit about how you got your start.
Yeah. So like you said, I'm a New York City firefighter for the last 16 or so years. And I absolutely love that job. I never even thought it was work, until somebody told me that was considered work. And, like a lot of firefighters, we work 24-hour shifts and then we have a couple of days off. So a lot of guys and girls have a second career, or a second job or a side hustle. And a lot of them do something in the trades, whether it's plumbing, heating, roofing, and, the like. But when I grew up, I was allergic to a hammer. My dad's allergic to a hammer. All my aunts and uncles, no one does any of that stuff. So, I had to find something that was good for me. And I ended up becoming a ER nurse in a level 1 trauma center. Did that for about 9 years. And life was good. I worked 2 jobs. I made my own schedule. The bills got paid. We went on vacation. The retirement account was getting, deposits. But really, real estate was one of those things I always aspired to do someday. It was that someday mentality that I now know actually has a name. It's called the arrival fallacy or the destination fallacy. And it was just, I never had enough money. I didn't have enough time. I didn't have enough resources. I didn't know how. I didn't know who to go to, or how to just get started, right? So that action, that first step of action was always elusive for me. But then, honestly, the summer of 19 came and I finally read Rich Dad, Poor Dad, the book that had been sitting in my firehouse overnight bag for at least a year. And it simply changed everything. I was on a family vacation in the Outer Banks, North Carolina, and I read it in like a day and a half, 2 days. And it really, it was as if the curtain was lifted, the sun was shining, and I was like, I'm going to be a real estate investor, and that just kind of got the ball rolling. It really kind of spurred me to, hit that little icon on my iPhone that says podcast that I never, ever touched once in my life. And I just realized, oh my God, there is so much information out there. I became an avid consumer of all things real estate. So that was the summer of 19. By November of 19, I'm buying my first 3-family rental property that I still own and manage to this day. And that just gave us our proof of concept. For me and my wife, it was, a big leap of faith almost. I had never done this before. My wife knows the lack of handyman skills that I possess. And she was like, dude, how are you going to do this? And, but anyway, I was defiantly committed to make it happen. And that really got the ball rolling. So I'll throw it back to you if you want to unpack some of that, but I can keep going. Yeah.
Yeah, there's a lot you mentioned there, and I'd like to start off with just hearing about your experience with the fire department. How has that shaped you in a way that has helped you as a real estate investor?
Oh man, I think we could spend the whole podcast on that. The thing about being a firefighter, especially in a big city like New York, is that every day is literally nonstop, right? And it's not always fires. It could be car accidents or people, hit by cars or buses or gas explosion. Like there's always something new, and there's always so many people to be helped in a 24-hour period. That it really for me was like an existential awakening that our life is valuable, our time is valuable. Having a lot of great days in the firehouse with tons of laughs with great people, and then a handful of soul sucking days where you see absolute like tragedy really reinforced to me that idea that I wanted to be more, do more, and have more couldn't just be an idea anymore. It had to become an action. So I think having that perspective, tied in with the level 1 trauma center, right? I literally couldn't get away from like the craziness. But just seeing
I feel
how
like that's
fragile...
like a personality. Like were you going for that? Like, do you like the adrenaline and sort of, the high intensity environments?
I do. I like to be the guy in the room, right? When something's going bad, like I want to go fix it, no matter what it is. And, I want to be the person in the room to maintain that calm and focus and to get things done. Right. So that kind of perspective really, propelled me forward to say, all right, what can I do for my family to maximize my time, to provide, a great life for not only my wife, but my 3 little girls who are now 10, 7, and 2. I mean, having all that wrapped up into one was really the impetus for me to take the next step.
Really interesting. Yeah. And I think that's also interesting to just have that level of sort of awareness around your personality type and the type of personality that you need to sort of pursue real estate investing as an entrepreneur, right? Because there generally can be a lot of risks that you're taking on if you're sponsoring deals or starting a business as you've started. And when it comes to that, I think back oftentimes, when I was young, I was big into like the extreme sports, skateboarding and snowboarding, just things that would kind of get my adrenaline going. Always kind of, I sort of enjoyed that to a degree. And I feel like now I definitely don't take anywhere near those sort of physical risks that I used to. But at the same time, I still feel like, there's an element where I thrive in environments of risk or higher pressure. And I would imagine, your career is not all that much different in that sense where, after spending so much time in those environments, when you're in the midst of a capital raise and everyone's freaking out, or if you're in the midst of, dealing with one of the more metaphorical fires that take place in the real estate world, which happen, once a week. When you start to build a big enough portfolio, you can keep your calm and hopefully, use that energy to navigate well through those situations. Right.
100%. Absolutely.
Love that. So I want to dive more into what I thought was really a unique decision you made early on as you started to get into multifamily. It sounds like you and your brother had done a few deals and started to build a track record, and you said, hey, we have a good network of folks that we have interest in working with. We have a good network of very experienced deal sponsors. Let's look into going the route of being a legitimate broker dealer and building a company that helps service investors through vetting the right sponsors and help service the sponsors through helping partner with them through bringing in capital into their deals. So I'm sure that for a lot of the audience, they're not familiar with where to even start with a model like that or what the advantages are. So perhaps you can just give us just a general overview of when you hit that fork in the road to make that decision and why you feel like it was a good decision for you, a good route for you to go.
Yeah. So when we got into multifamily, I didn't even know, the ins and outs of syndication. I wanted to do my own deals with my family and friends. And we were quickly introduced to syndication with a mentor of mine. And once I saw the power of it and how truly passive it could be, and, with great returns for investors, I was immediately hooked. And, one deal led to the second, led to the third, which led Greg and I. I'm up in New York, and Greg is down in Virginia. So it's really, and we both have W-2 jobs, right? And we have kids, right? All these excuses I know that people don't want to hear. But I wasn't going to be a boots on the ground guy in, say, Florida or Georgia or Texas, and neither was he, right? So we very quickly found out that real estate, and specifically multifamily commercial real estate, is a team sport. And Greg and I are big sports guys, and we kind of just had to figure out, where was our spot on the team gonna be? Where could we add the most value? And I think for us, growing up outside of New York City, we just had an incredible ecosystem of family, friends, college, roommates, and the like. And we were able to have those conversations early on, even not having a ton of experience, and kind of educating people that are either super successful, super educated themselves, and they just didn't know what was available to them. They never heard of real estate syndication, passive investing. It almost sounded too good to be true, And, by having those conversations and coming from a position of like the trifecta of what you need to raise capital, of people know you, like you, and trust you, I think that we had some early success in connecting some of the dots for the people in our inner circle. So when Greg and I kind of, came together and said, all right, well, where are we going to have the most value, and where could we, find our spot on the team? It was really capital raising. The flip side to capital raising is that you can't just raise capital for deals and go on to the next deal. Like, you have to have a material participation and in that general partnership, right? In the asset management of each, individual deal. Or else the SEC frowns upon that, and you could end up in jail. And that's not something that Greg and I were willing to even discover. So to kind of fill that void of, hey, we're good at raising capital, and maybe to marry some of those skills with some of the operators out there, because there's a tremendous need for two things, right? Deals and capital. And we weren't going to be boots on the ground. So that's kind of how we came to our decision. So we were connected through networking with a multifamily focused broker dealer that had onboarded through a due diligence process 7 multifamily sponsors and one self-storage sponsor. And the idea was, sponsors themselves can raise, a couple million to tens of millions by themselves, but eventually they either tap out their investor base, or they just want to go do a bigger deal that requires more equity. And, yes, there's other ways to get that equity: family offices, private equity groups, pref equity groups, hedge funds, pension funds. But usually those bigger players, in exchange for bringing that one big check to the deal, they don't want to come in as an LP. They want to come in as a joint venture or as a general partner. And it starts to get a little bit, the operators start to lose some of their autonomy in, voting and deal making and making decisions. So in exchange for that big check, right? And they might come with hurdles as well, like 24, 36-month lockout periods, other pref, returns, preferred returns, so there's a whole need for that middle market equity. And that's kind of what our platform does, is we can bring the investors into the deal, to satisfy the equity requirements, but we're not looking for, exchange of voting rights or extra preferred hurdles or anything like that. So once I heard the model, I said that, that's brilliant. And that's kind of what Greg and I are looking to do. And it kind of just all fell into place at the right time. And so how that works is that, to be associated with a broker dealer, you have to take a few
And maybe
exams.
just tell us, what is a broker dealer?
So a broker dealer is nothing more than someone who has a license from FINRA and the SEC to be able to sell securities. So essentially, when you invest in a 506B offering or a 506C offering or a crowdfunding offering, those are securities that are essentially being sold through a private placement, like a direct participation program, they're called. So that's really why people can't just raise capital and walk away, because essentially they're selling securities without having a license. So I know we're getting
the one
into the
exception
weeds.
is that if you are doing the deal yourself, you can raise the money yourself, right? And that's ultimately what our group does, right? And it's similar to, you can property manage yourself without a real estate license, right? You're allowed to manage your own properties, but the moment you want to go and manage someone else's properties, you need a real estate license. Similar in the fact that if you want to go and raise money for someone else's deal, you need a securities license, right?
That's it. I mean, what 506B and C are essentially, they're called exemptions, right? So everybody who sells a security has to file, papers with the SEC saying, I want to, sell stock. I want to sell whatever security you're going to sell. But the SEC, there's tons and tons of exemptions, right? Municipal bonds, commercial paper, like there's a ton of exemptions. And one of those exemptions is 506B and 506, what's called Regulation D, 506B and 506C offerings. So the operators themselves can use that exemption and go raise an unlimited amount of capital. But there are obviously rules around that. So Greg and I, we decided, hey, listen, this guy, the broker dealer, it was two gentlemen, one in Texas and one in New York. They came together. One had the multifamily operator relationships, right? And the guy in New York had the broker dealer license. So he's bringing an incredible amount of compliance and legal compliance to this platform so that we can go out to our investors and say, we're working with these 8 or 9 sponsors. They've been vetted by the broker dealer, because at the end of the day, it's his business, and it's his license, right? So he flew all across the country, walked all these different properties with all the different sponsors, went through their books, went through their business plans. Are they paying investors like they said they were going to pay them? Are they following through on the pro forma? And there was an onboarding process, criminal background checks, fingerprints. So at the end of the day, when somebody comes on the platform, we can feel really comfortable that they're a established, experienced sponsor who has been doing the right thing for their investors. They have good underwriting, habits, and experience. And then when we go to market with our investors, it's almost as if they're getting a doubly underwritten and doubly vetted deal, right? Because the lead sponsor, whatever group we're working with, they get the deal on the contract. They do their due diligence. They give us a heads up that they have something on the hook. And then our team goes to work. We underwrite the deal again. And as long as it checks all the boxes, right? We have a certain criteria as far as returns, as far as asset profile, geographic market, some macro indicators. And as long as those boxes are checked, then we can go to market with our investors. And it's almost like a more of a risk adjusted way to invest in real estate. So with that being said, we've had some tremendous success in the last 4 or 5 deals. Because of using that model, people have been more, they're more comfortable with the process.
Yeah, I like that a lot. I think it's really helpful for the investors, because they're seeing that you guys have taken a more diligent approach to vetting these sponsors than virtually any LP is going to be able to do, right? I'm sure, like you said, flying out to the properties, checking the books, maybe getting audited financials, right? I'm sure there's all kinds of things that go into that sort of vetting process, the background checks and so on. So that, I'm sure, gives a tremendous amount of peace of mind to the sponsors, knowing that they're not just investing with some fly-by-night group that's in and out, or that's brand new to this, right? Or that has, overpromised and have a track record of overpromising and underdelivering, or something along those lines, right? Mm-hmm. So I think that's huge, because for most people, you always hear the sponsor is the most important component of your decision, right? And making sure that you're vetting the jockey more than the horse, so to speak, right? So tell us about that when you are doing the vetting on either the sponsor or the deal itself. What do you believe are the biggest risks that you steer clear of?
Yeah, I mean, I have conversations with investors every day that the hardest part of their job is to vet the sponsor and to vet the deal. But the value that our platform can give is that we take that off of the passive investor's plate. We do the due diligence on the sponsors, and we vet the deal itself. So where that was the hardest part of their day, if they don't use a platform such as ours, vetting the sponsor, vetting the deal, that's a value that we can give to the investors. There's nothing wrong with getting started, because we all start somewhere, right? But there is something to be said for an experienced operator that has been in the trenches. We were talking offline before the show started. There's a couple of fires, that once a week, right, that can come up. And, if you don't have that depth of experience with dealing with some of those, issues, investor returns can suffer, right? And at the end of the day, if you're going to be a custodian of your, investors' funds, right, and a fiduciary of your customers' capital, you want to make sure that you're working with and placing capital with highly experienced and high quality sponsors.
Yeah, that makes a ton of sense. There's no doubt about it that having someone that is vetted upfront goes a long way. Having someone, the longer the history they have, the more lumps they've taken. I can guarantee you that, right? And every lump you take, every time you experience those painful situations, you learn from them and you adopt. Mm-hmm. I mean, if you're a good sponsor, right, you're gonna try to not make the same mistake, two or three times, and just learn from those things and pick them up. So I think having the vetted sponsors that you're bringing capital to makes a tremendous amount of sense. Plus, I'm sure you're vetting all of the deal arrangements too, right? There's very often I'll have less experienced limited partner investors that send stuff to me, and the terms are not quite what they were expecting them to be, right? Or they have say a less LP friendly setup, right? So you're also vetting not only the sponsor, making sure they're reputable, but you're also vetting to make sure that the LP is getting a fair arrangement on their side, right? And there's nothing in the fine print that's going to come back to bite them later on.
That's 100%, right? So some of our, obviously the majority of our retail investors are looking to, invest, say, 50,000, 100,000. That's the bread and butter of our operation. So an 80-20, 70-30 split will make sense for them, maybe with a hurdle down the line of a certain IRR, mm-hmm. Say 15, 17%, something like that. Where on the institutional side, we've recently begun working with some institutional partners. They're looking more for like an 80-20 split, no hurdles, just through and through, straight, clean, and, that's it. So there's definitely different terms between retail and institutional, mm-hmm. and stuff like that. But yeah, I mean, like, we invest alongside our investors in each one of the deals. And so we're considered like a limited partner as well, right? Because, mm-hmm. Yes, we're on the general partnership side as co-sponsors, but we're also investing, I'm investing the Lyons family funds in these deals as well. So, so that 80-20, 70-30, that's generally what we're looking at. If there's something, other than that, we're probably not going to be putting it out to our investors. And we also don't say yes to every deal. Just because a deal comes across our desk doesn't mean that we have to put it out to investors, that, we love the deal or anything like that. So to be in a position where we are right now with the deal flow from multiple sponsors that we get to look through and say, yes, we want to participate, or we're going to pass, or whatever. And also just knowing what the appetite from our investors. Are they looking for, certain geographic regions, tax-friendly states versus, whatever, so, if it's in a random state, I'll say, then maybe we won't do it because we just know that our investors have not indicated that that's something that they are interested in getting into.
Makes total sense. Now, we all learn from either our own mistakes or the mistakes of others. Of course, the goal of the show is always to help listeners do the latter. What's one painful learning lesson you've had early on that is worth sharing?
Thinking that once we had a good deal, that the money was just going to automatically start raining down on us. There's certain people out there who are like, in the education type space or the guru space in real estate that kind of preach, if you have a good deal, the money will show up. And that's debatable to me, because there's really, I think we talked about it before, the three main ingredients to raising that capital is people need to know you, like you, and trust you, whether it's me or the operator or somebody in that deal. Because really the deal is like the fourth or the fifth thing that the investors are looking at. They want to feel good about coming on the journey with the operator or someone like myself, or in that market or that asset class itself, before they even get to kind of the deal. So early on, we committed to a property that we thought we could raise all this money on because it was just a screaming deal. And we came up short, right? So, it's, you kind of have to put your tail between your legs, go back to the drawing board. What was it? Was it, our communication style? Was it, because Greg and I, we're just not salesmen. Like, we're not salesy people. We're just talking about the deal. We're talking about the market, so we really kind of had to deconstruct how we, put the deal out, and, I think going through that process was helpful for us as far as streamlining, our marketing effort when we put a deal out.
That makes a lot of sense. Yeah, I think it's a really good point, right? Is that the capital side is so dependent on your existing relationships. And that's really where people are investing with you oftentimes because they know you or they've done deals with you. I like what you said there of know, like, and trust. I use that often. Right. And they may know you and like you, but if you don't have the track record early on, they may not trust you yet. Right. They might trust you from a friend perspective and believe you're well-intentioned, but if you don't have the track record, they may not trust that you know what you're fully doing yet on this side. They're going to think you're going to do your best, but it may not be there to execute yet, right? So
that's 100%. I mean, like, a lot of my friends, like, I watch their kids, they sleep over my house. They trust me and they like me, but they don't know the real estate piece of it yet, And so yeah, I mean, once you have all three of those things, that's when you can really start raising the capital.
Yep, exactly. So what does your 3-year and 10-year vision look like?
So everybody always asks me, Tim, how come, with all your, real estate success, how come you haven't left the firehouse yet and concentrated, solely on real estate? And it's really because I love what I do, right? I still love going to the firehouse. I'm not even close to being ready to leaving. But in 3 or 4 years, when I'm eligible to retire, that's a real possibility, to be able to, get out, a healthy young man and be able to kind of dive in full time to commercial real estate. So that would kind of be the 3-year plan. In 10 years, look, who knows what happens in 10 years, but, we're doing what we're doing now in the capital raising space. And really kind of getting into the multifamily and self-storage deals. But I would love to, at some point, have our seasoned list of investors who have been on the journey with us for, several years and kind of do our own deal as a lead sponsor. I think that would probably be the end goal for a 10-year time span.
Nice. I think it's great. Give us 2 best practices. What's one best practice for active operators to seek out their first deal, and give us another best practice for passive investors to seek out passively investing into a multifamily or self-storage asset?
You know what? I'm a simple guy, so I'm going to take one at a time, right? So the first one was for the sponsors, right? It's like, there is no question in my mind, and it sounds so cliche, but real estate is literally relationships and networking, right? If you just call some broker once and then you never call them again, you're literally never going to hear back from them. It's making those human connections. It's not just the email. It's not a text. It's not a voicemail. It's going out and seeing them, shaking their hand, getting some coffee. It's developing that relationship. So then when something does come up, they think of Tim Lyons or Dylan Marma, right? So I think it's really the relationship and networking aspect of it, and it takes time. The second one for passive investor, the question was what should they do to
what's
get
the
started?
best practice for them? Like maybe a tip around vetting a sponsor or a deal. Let's try to avoid the generic vet the sponsor first, since we already hit on that.
Yeah. I mean, it could be hard to get started, right? It's for anything in life. It's hard to get started. It's hard to start working out, losing weight, eating right, investing in real estate, the whole nine. But nothing worth pursuing doesn't come without difficulty. So if you're getting into the multifamily space or the passive investing space, I would try to meet other people that have done it before you. Try to go to that local meetup. Try to go to that online, maybe webinar that's going over some of these things, because you will meet people, believe it or not, on these online, webinars and stuff. You can connect with them, bring a conversation offline. And just really kind of get their experience. Hey, how did you do it? What did it feel like? After you invested your money, how long did it take to get your first distribution? All these questions that, I now know are those frequently asked questions that we try to address ahead of time. Had I known about some of this stuff in the beginning, I may never have bought that 3-family property. So it's just really kind of connecting with people, seeing what their experience is. And then, as you know, once the ball is rolling, they're going to say, stay away from that guy. You want to go over here. That's a great market, stuff like that. So that's what I got.
Yeah. And that's a great point, right? It's don't be afraid to ask. I think there's so many people out there that are happy to help. It's a very, I think, pretty overall transparent culture, I find, with a lot of folks like ourselves that are in the real estate space. So if, some guy approaches you at the meetup and tells you have to make a quick decision to invest in his once in a lifetime deal, you can, be patient, look the other way, and definitely, I like you said, talk to other people about their experiences investing with said sponsor, talk to them about what they like about the market or the asset class, right? There's no rush to just jump into the first thing that crosses your path. And you're definitely not on your own island, right? I think that's important for all of us, no matter where you are, passive, active, that you're, reaching out to those around you that have done this stuff before.
100%.
Awesome. And Tim, where can listeners find you online and connect with you?
Yeah, so I'm pretty active on LinkedIn under Timothy Lyons, on Facebook, and you can go to the website at www.citysidecap.com. And yeah, those are some of the best ways you can connect.
All right. Awesome. Well, there you have it. Thanks a lot, Tim, for joining us on today's show. I definitely got a lot of value here. I love what you're doing. I think it's a great strategy, an awesome way to scale up and partner with the right individuals, learn the space, and help a lot of people along the way. So definitely appreciate you jumping on here, and looking forward to continuing to grow with you in this real estate adventure we're on.
Yeah, Dylan, thank you so much. I'm grateful for the opportunity to come on today and talk to your listeners.
All right. Thanks a lot.
Bye now.
Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the Requity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk, and past performance is no guarantee of future results. The views and opinions expressed by the Requity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.